many people still logging in, but we want to get started. Good day, everyone. My name is Michael Brohan from ITM 21st, and I want to welcome everyone for taking the time out of your busy schedule and taking part in today's session. For today, a little bit of housekeeping. There's a copy of the handout for the session. It's actually was sent out in the reminder, and it's also on the website at ITM 21st. That's 21st.com. Just click on education, then on today's session where you'll find the handbook. Also, the CE attendee form is there. It's in a blue box, and it will always be there at the bottom of the page. You can click on the form to download it, and there are directions for sending that back. So if you want CFP or CTFA CE for this session, just go to the website and get that, download it, and send it back in. It would also be applicable for Firma Credit. That's the Fiduciary Investment Risk Management Association, which we're happy is a part of taking part in our sessions also. So if you want the CE, just go to the website and fill out the form. You'll also notice that you can ask questions along the way by typing them in, and if you do have a question, please do ask your question. If it's something that needs to be brought up at the time, I will stop John and we will deal with the question at that time. If not, we'll just bring it up to the end. But please, if you do have a question, do reach out and type it in and send it in. I want to take a minute right now to let you know about our next session on policy reviews. As you know, policy reviews are the backbone of our work here at ITM 21st and a requirement for trust fiduciaries. Aaron Hansen, who heads up our remediation department, and I will be doing a session that will feature our new insight reports and will provide a guide for the annual policy review requirements for a trust fiduciary. John, can you move the slide forward? But today, we're happy to have John Mendelson from the Asher Group here to talk about an important topic, which is life settlements. I wanted to have a real nuts and bolts presentation because a lot of fiduciaries simply do not understand the process behind a life settlement, and I think it's very important that people do. And John is really the best one to do this. I've known John for many years. He's an advocate for best practices in this industry. He's a member of the faculty here at ITM 21st University, and he's spoken across the country, not only for us, but at many industry events and provided many webinars and sessions educating the industry and also advisors such as yourself. And John works with people like you, like those on this call, to maximize the value of life insurance policies for their clients. He's been a great resource for us, and many of our clients use him, not because we've referred him, though we would not hesitate to do so, but because he is so well known in the TOLI market that our clients have reached out to him on their own. So I'm looking forward to his presentation myself. So John, take it away. Thanks.
All right, thank you, Mike, and thank you to ITM 21st for this opportunity to share about the life settlement market and really how to just responsibly serve your clients, how to identify opportunities or prevent any issues that might arise that might mean or could put you in a position where you miss a planning situation for this client as your role as their advisor or a fiduciary. I'd also like to share that my firm does not sell life insurance. We do not do any life insurance planning. We do not manage assets. We serve as an independent specialist in the life settlement and longevity space, and understanding truly just how to value a policy for families and business owners. We've done this for almost 15 years. We have billions of comps and transactional data, so we can really tell you what this policy could be worth and how longevity could really impact the recommendations you make with clients. I'm going to kind of breeze through this a little bit just so I can make sure we leave enough time for discussions as we move forward. We've been asked to write about this and been published in many of the top publications and estate and tax planning conferences across the country. And it all really comes down to this one slide that's changing the world that we live in today. And I know it's a kind of a fun slide, and I know Mike got a kick out of it, wondering where I was going to be going with this, as he said. But one of the main influencers that's really impacting recommendation of these types of policies, and especially on the life insurance planning, TOLI, and life settlement market is increased longevity among all these types of clients that we serve. It's not uncommon when I speak at events around the country, if I say, raise your hand if you by chance have a client that's living well into their 90s, and the majority of hands go up. Now, most of those clients did not plan to live into their 90s, and their advisors had not put together their financial plan, estate planning, and caregiving requirements as if they were living into their 90s. So now you have a major amount of planning and opportunities that not only affects them, but affects their 60 to 70-year-old, maybe even 70-year-old children, and the adult children and the grandchildren. So we're talking about a pretty significant issue or opportunity depending on how you identify this among the clients that you serve. So once again, going through the problem is with the shifting demographics, and it's moving very quickly, how do you responsibly serve this aging population and all their adult children? In fact, many of their adult children that you work with today that are in their 40s and 60s may not even do the planning recommendations that you make, because their mental and financial bandwidth is fully tied up in caring for their loved ones. So if you had the opportunity to serve them after this presentation today, I can assure you, you're going to spot opportunities where a policy might have more value than the cash surrender value in the contract. And being able to go through the life settlement process, as you'll see, might be a way to create that liquidity event that opens up all the doors to planning, not only for that matriarch or patriarch in the family, but also for their children and grandchildren. So the big problem we have is there's a lack of awareness about the life settlement solution. We work with some of the most sophisticated banks, trust departments, fiduciaries, and other financial planning professionals who simply have never been exposed to this at a deep level. They haven't had a lot of training. They've never really gone through courses on how to value or appraise a policy. Sometimes there's outdated rules like the interpolated terminal reserve that don't necessarily apply to their day in, day out. So how do you do this, and how do you learn? So thankfully, companies like ITM 21st are doing webinars like this today, and many of the others that they provide throughout the year. But there's also types of concerns, whether it's elder financial abuse. We worked with the client on the West Coast where this is a pretty significant discussion. How are they documenting the file when dealing with senior clients? Are they omitting or not providing a comprehensive policy review and maybe ignoring the most valuable asset that client owns? Are they not getting the right type of caregiving? Because in order to fund that caregiving requirement, it takes a lot of liquidity, and that liquidity might be spread among the children, the adult children, and they can't afford to put it all together. Maybe it's caused levels of dysfunction. There's so many things to do. And then lastly, how do you determine who is aligned with you as that trusted advisor? How do you make sure that the party that you're taking advice or recommendations from actually knows the business and is looking out for your best interests? We're going to go through all these types of problems. But for those of you that this is a new solution, let's just talk about just the nuts and bolts of what a life settlement is. It's a highly regulated transaction today compared to 10 to 15 years ago when there was not a lot of regulation. It's regulated in 90+% of the states. It's a legal right for policy owners to be able to sell this asset no different than any other piece of property that they own. So it's just the sale of a life insurance policy that for whatever reason has outlived its purpose. Maybe the kids have grown up, they sold their business, a shift in estate size, whatever the reason is, the policy was put in place for the right reason years ago, but today those reasons might have changed, like many things change in people's lives. And instead of just cashing it in for the surrender value, they have another option to consider. They might consider working with a specialist that knows how to value these types of assets and determine if the policy could be worth many more times than that surrender value. Here's a quick example of that. We worked with the family. It was with a trust department, and within that trust department, they had a policy that was a little under $3 million. And this $3 million policy was purchased many years ago, was underfunded, and as they go through this, they were trying to determine what they do next for this policy. Well, the reality was that this policy had significant value in the secondary market. Instead of surrendering it for the little over $70,000, they were able to monetize the policy for $1.1 million. So you're talking about a significant value to the trust. So instead of just surrendering that policy or paying that escalated premium that you saw, which no one wanted to come up with, they were able to take that policy, appraise it, value it like any other asset, and the fair market value was a little over $1 million. And the clients were able to use those proceeds to help fund other areas of their life. When you just see that one example, and I can tell you that we work with so many different types of fiduciaries and trust departments, banks, all the sort, all over the country, and 50% of the policies we work with are trust-owned. Can you imagine not addressing this in this way? Can you imagine if the family would have left that 7 figures on the table because their advisors had not taken the time to do what you're doing today? Become educated, become trained in this, and start to understand that there might be more value than the stated value in the contract. I'm sure if your client owned a piece of real estate, they would never just walk away with it without first taking it to market. We have a similar conversation here. Another one of our most common examples is a retiring business owner. This one happened to be a male, age 72, had a couple $1 million term policy that was right at the end of that period where you're able to still convert it to a permanent policy. Had a change of health since it was issued, and they just didn't need the coverage. They had plenty of coverage for their estate planning purposes. So one of their advisors had said, well, gosh, it's outlived its purpose. Why don't we just let it go? You know, you paid the premium for years. It's worth $0 on the balance sheet. Well, one of the other advisors that worked with the client said, I'm not sure if this will make sense or not, but I work with a firm that knows how to value these types of assets. Why don't we reach out to them just to make sure we're not leaving any potential liquidity on the table? We went through our process that I'm going to touch base on as we go through this conversation today, and it was worth $630,000 for that policy. So we're talking about significant dollars that this policy would be worth. Now, how in the world is that even possible? How could a term policy be worth that, and who would even purchase a policy like that? Those are one of the most common questions that we hear as we work in this space. And so I want to give you a little bit of a glimpse behind what that is. Over the past 15 years, my firm, we work with many of the world's largest asset managers, private equity, pension plans, and other types of sophisticated funds that see life insurance as a non-correlated asset class. To them, they could spend and deploy a significant amount of capital and build a large mutual fund-like portfolio of policies. They understand that life insurance carriers perform better than banks, many of the banks in the credit crisis. And with the amount of strong consumer-centric regulation that's now out on the books, they don't have to worry about the types of abuses from 10 to 15 years ago that were happening in this space and many others. So there's significant amount of increased transparency. There's a clear delineation between those parties that represent the client and those that represent the purchaser. We're going to cover those types of things today. But one thing to pay really close attention to is that last bullet, the disintermediation trend. The reality is that with any market that's really thriving like this market, you have those that are chasing yield. So there's different funds, and these are not, the quote evil capitalists. They're purchasers. They're trying to get the best rate of return that they can for their institutional fund. So in their world, what they're doing is they're doing a lot of direct-to-consumer marketing, and this is something that's worth paying attention to, because no different than if you were selling your home or any other asset, you'd want to have more parties bidding on your home or your piece of property than less. And you'd want to make sure that you had someone representing you that knew the ins and outs of the market. So we're going to talk about that too as well as we move through this. So the number one issue for those of you on the phone today is really, like any transaction that you work with, the alignment of interests. So who are you working with, and do they have a 100% fiduciary responsibility to your client, or do they sit on the opposite side of the table? Because that type of information, as you go into any type of asset sale, is what's key, because can you trust what you're looking at? Are they providing the type of disclosure that would help you document your file, defend your recommendations? Or when the family or business owner asks you for recommendations, do you know that everything that's being shared is in their best interest? So we're going to talk about those types of things. So licensed entities, they're all different types. There's those that I talked about have a responsibility to the client, and those that have a responsibility to the fund purchasing the policy. You can go through a series of questions as you explore who's representing who in the transaction. Do these individuals only work with institutional buyers, or do they work with individual investors? Firms such as ours and many others within the market only work with credible, legitimate institutional buyers. We do not work with John or Jane Doe that's purchasing a policy. That doesn't happen if you work in the licensed, regulated secondary market. Will they provide written transparency of all the independent buyers? Can they show that in rep and warrant that they actually took the policy to market? No different than some of the trusted insurance advisors you work with that when they do a policy analysis or competitive analysis are giving you a broad market overview of that. Can they explain to you how they complete their bidding process, and how does that work? What type of information they share? Is that something that you're getting, that type of transparency? And I can provide more of these types of questions for your due diligence file as we go through this or in the future. Do they provide written disclosure of all their different fee formulas and how they're compensated? And then you want to know some of the basics, such as, can you tell me a little bit about your firm? The principals that are involved. What side of the transaction do they sit on? Have they ever had any regulatory or legal issues? All the basic things that you go through. Do they use state-approved forms with all the reps, warranties, disclosures? A lot of that takes place because, as I shared earlier, here's a quick regulatory map. All of the states except the gray ones have regulation on the books. Some of them have a couple-year waiting period where the client is told that they cannot sell the policy until they've owned it for 2, 4, or 5 years. But there's a lot of carve-outs, such as financial changes that the client might have gone through, health changes, all different types of things. Since all this type of regulation was put on the books, and it was specifically put there to protect against different types of what was called TOLI, stranger-originated life insurance abuses, where certain clients were having policies or purchasing policies that truly had no need for those policies themselves. So those regulations were put in place, but that problem doesn't even exist anymore. It's just not an issue. So we're talking about a highly regulated market. Even the states that don't have current regulation on the books, every legitimate buyer still has full transparency. You should still, from any entity you work with, receive the same bit of disclosure as you go through there. There's even some tax treatment revenue rulings that came out, revenue ruling 2009, 13, and 14. We can provide an article on that. That's really a whole separate type of a conversation to go through there. But the purpose for me sharing that is that it's now recognized by the IRS, and that this is a legitimate type of asset sale for a client to go through, and there's revenue rulings to demonstrate that. If I take a step back, I truly, 15 years ago, would never have been able to connect the dots looking forward. I can only do that looking backward. If you look at this diagram, about 15 years ago, on the far left of this curve, this bell-shaped curve, we have the innovators. We had a lot of really aggressive life insurance producers that were getting involved in this market. And that slowly spread a little bit into the early adopters that did a little bit of financial planning, but were pretty much insurance-centric types of advisors. Where we are today, and why this is such a phenomenal market to be in today, is we're now entering into this early majority. And we're in this section where we had hundreds of firms that signed up for this webinar today that are in the fiduciary side of the transaction. They understand that many times life insurance as an asset is one of those hard to value assets. What do you do? How do you work with it? And how do you have an independent analysis so you know what it's worth? So we're seeing a lot more growth in this early majority with fiduciaries, banks, trust departments, just like you, that are getting involved and understanding they cannot ignore this. If they miss an opportunity and a client lapses a policy worth 6 to 7 figures, that could be a significant problem. We're seeing, an expanding fiduciary standard. Will life insurance fall under that with the DOL or all these other things happening? I'm not so sure. We'll see what happens. There's a lot of controversy with the fiduciary rule. I can tell you this, with a lot of the banks and trust departments, and broker-dealers that we work with, a lot of them do not want to have a separate workflow for the DOL fiduciary rule, and they're folding in life insurance into that. And as they do that, there's higher standards and best interests that have to be addressed as we go through there. If you look at that very last bullet, there was even a client that had an issue because the policy they were not told that the policy could have value in the secondary market. That case ended up settling. However, the most important part of it is they were talking about elder financial abuse, and this is in California, for not disclosing that this was a legal right to the client. All I would encourage you to do today is, like everything else you do in your practice, the more transparency and disclosure, the higher probability of trust and good results you'll have with your clients. So let's talk about who represents whom within this transaction. And if you imagine this was a boardroom, and that line down the middle was just a table in the boardroom. On one side of the table, you have the buy side, the purchasers that are looking to purchase policies. It's some of the world's largest private equity, pension plans, reinsurers, on, that are some of the largest purchasers of policies that have multi-billion-dollar portfolios of policies. Some of these reinsurers, they might have a couple billion dollar pool of mortality risk. Can you think of a better way to hedge that than a couple billion-dollar pool of longevity risk? The thing they all have in common is that on that side of the table, they have 100% fiduciary responsibility to their rate of return and the investor. They have to do what's right. They want for their fund. They're looking for policies that were put in place for all the right reasons. They don't care how potentially advantageous it might be to purchase the policy. If there's any concerns of fraud, they do not want it, period. There's no light between that. On the other side of the table, we have the sell side, like you're selling any other asset or piece of property that you own. We have the entire advisory team that represents the policy owner. The very last one is the settlement broker, a firm like ours that is nationally licensed to collaborate with the entire advisory team. We have a 100% responsibility to the policy owner and the client. There's no light between that as well. We have to provide full transparency and full disclosure along the way. It's the responsibility of that licensed party to help guide you through this process, maybe provide an arm's distance from the transaction, because there might be things that as a bank or trust department you're unaware of that we know because we experience it every single day. Everyone on this side of the transaction who's guided by that life settlement advocate should be using best practices and all of what you would expect to run or to work within a sophisticated transaction. Talking about protecting a client's best interest, back to that side of the transaction, you want someone who's independent, who can look at the entire market, not just one offer or what one potential bid can be if you're looking to do a life settlement. Many times you might have an offer that appears to be very strong, but as you continue to analyze it, you continue to have competitive bidding, that offer becomes double or triple with over a period of days or a couple of weeks. So having that independent type of resource that knows the market is very important. You also want to make sure, if at all possible, they don't sell a bunch of competitive products that could conflict with what your overall planning is. You want to make sure that they're providing this data point and you can help make the best decision with the client themselves as they do this. And of course, on that last bullet, have a compliance-centric process that protects all parties within the transaction, and everyone's willing to sign off on that. So it's not just a relationship transaction. You want that as well, of course, but you want to make sure all I's are dotted and T's are crossed as you go through that. We here have the missing key, or the invisible key that we know we all have on our keyboard, or we wish we did, when we go through a process and then we have that kind of slow gulp where we realize we did not do something to document our file. And we should have covered our bases. I guess we'll call it, to class it up a little bit, we'll say the A stands for assets. Cover your assets. So whether you're a trustee, a trust advisor, you work at a bank or as an attorney or even a planner that has a responsibility to this client, to be able to document your file, take that, that independent, contemporaneous bit of information and be able to demonstrate that you did what you were supposed to do to ensure that this client was best positioned and all of their best interests were at heart. Many of the advisors and fiduciaries that we work with talk about life insurance. It's just one of the largest unmanaged assets a client owns. So they allocate a tremendous amount of liquidity on an annual basis, yet they haven't managed it like they manage their equities or other real estate they may own. I know obviously ITM 21st has done, kind of stepped up to the plate, and they've put together a phenomenal program for doing that for organizations like yours, which makes our life easier because we're dealing with much more educated and sophisticated types of fiduciaries in the market. Many of these trust departments and charities and other organizations where policies are either being managed or donated talk about life insurance almost like it's secondhand smoke that they're forced to interact with, because they've never had a resource like an ITM 21st or someone like our firm that knows how to actually handle, value, monitor all different types of those proactive types of approaches, these types of assets. So we're hopefully going to give you more clarity and comfort as you work through this conversation and understand how we can support what we know you're trying to do in your role as a fiduciary or as an advisor to these clients. So keeping it simple, how do you make a decision about any asset without first knowing its value? That's something where we come into play. As I talked about earlier, if it's a house or a piece of property, you pretty much know what you can do. You can look at comps, you can look at what's happening in your area, and you have an idea. But if someone said to you, I have two 5-bedroom, 3-bathroom houses, which one's worth more? You'd have a lot more questions than probably answers. You'd say, well, gosh, where are they located? When was it built? Have they been inspected? You'd go through a whole lot of things. What's happening? Well, what happens if you have 2 life insurance policies and someone says, I have 2 $3 million life insurance policies, or 250,000, doesn't really matter, life insurance policies, which is worth more? You'd have to go through a little bit of a process that would help us better understand what the longevity is, what's the carrier rating, what's the premium expense, what are the values in the policy, all different types of things that can go through. And I should say this, and I'll say it again in a little while, the longevity underwriting process that we go through is not invasive. No one's sent to the doctor. There's no medical exam required. There's no blood drawn, anything like that. It's really just a review of existing medical records as we go through our process itself. One of the concerns I talked about right from the start was this disintermediation. Clients lacking an advisor involved in the transaction. Direct-to-consumer types of approaches where a client might make a decision that's not advantageous for them. Just because we believe the policy in our market might be worth 5 or 10 times more than the cash or surrender value doesn't mean they should sell it as a life settlement. It might mean they should keep it. And I know that might be strange coming from someone in my business, but that's how we've built trust over the years, is by being very direct with the advisors we work with. Can they find a way to maintain the asset? Do they want to sell other assets, equities, real estate, anything, so they can keep that policy if we believe it's worth something significant? Can they come up with any alternative ways to fund the policy? There's all different types of discussions that need to be addressed as you go through this process. It's been our experience that people enjoy the liquidity event and they want to let the other assets that they own stay where they're at. But it doesn't mean that's right for everybody. So that's why we're a big believer in advisors being involved. When I say fair value on this slide compared to fair market value, I don't know anybody on the planet that wants to sell their house for fair value. They want to sell it for the highest amount they possibly can. Fair market value, the very top that the market will bear. They want as much of a liquidity event as they possibly can. Well, the same thing exists within our market. And I'm going to give you a snapshot of what this looks like. This could even be a whole presentation ourselves, but I'm just going to do my best to give you the high points on it so we can maintain the time frames for this webinar. This, as you see at the top, was a $4 million policy with a little over $100,000 for a surrender value. If you look at that offer number 1 from a provider, a buyer of a policy, we're using the word provider, they bid $411,000. Pretty fantastic. The client could get $300,000 more than their surrender value. The reality is that's what many clients do, unless they work with someone that knows how to navigate this market. And as if you look all the other bids and the offers that came across this market, by actually working with someone that knew where the most aggressive capital would be for these types of policies, all the specifics of this client's longevity estimates, the policy ratings, the values, the premium, all the different metrics that we look at to create the most competitive bidding possible. No different than when you're issuing a life insurance policy. Many of the top insurance advisors would tell you, I received 4 declines, 2 table Bs, and then I got a standard somewhere else. Well, in our market, every buyer has a different need. Some are very strong at much longer life expectancies, and others are stronger at much shorter. Some will deal with different carrier ratings differently than others. There's all different types of things that they will look at, and it's all about the fair market value, the competitive nature of selling this asset, no different than selling any other asset. The market ended up topping out in this example at $1.55 million. So can you imagine being the trust department who went with that first offer at $411,000 and you left $1 million of value on the table for your client? That's something that if you work with a licensed advocate that has 100% responsibility to you, they should be able to provide you something just like this on any single policy, every single policy, that you work with, so you can have a defensible position. Each of these are independent buyers. They're not one buyer that has multiple types of funding relationships. So we're talking about a total transparent, fully disclosed type of bidding process. This is exactly what you would want for your home. Why wouldn't you want it for any other asset that you own? So who's the ideal client? From a policy perspective, we work with every type of policy out there. However, 90% of them seem to be a universal life or a convertible term that's convertible to universal life. And that can be convertible to an index universal life, a guaranteed universal life, a survivorship with 2 lives, any type of policy we can work with. But these are the most common policies that on average are $100,000 to $5 million. And we even have worked with family offices on a daily basis that have larger face policies in the $5 to $50 million range. We work with Fortune 25 executives that have large term key person policies. And once again, as I talked about earlier, even though they don't have cash value, such as term and lots of guaranteed universal life, they might still have significant value when we look at the combination between the longevity and the premium expense on that policy. From a health perspective, it's typically the retirement age, people in their 65 that are 65 and older. However, if they're highly impaired, we've worked and helped appraise and monetize policies with people that are in their 40s and 50s. The ideal policy, that there's been a change of health since issue, and we work with longevity and life expectancies that are out as long as 15 years plus or minus. So if they're older, they have a lot of age-related impairments. If they're younger, they probably have more significant health issues. There's so many reasons for even exiting a policy. For the same reasons they put that policy in place, they just no longer want to fund the policy, or they want to reallocate those premiums into AUM. Maybe the kids have grown up, they sold their business, the change of estate size, funding caregiving for their spouse. There's so many different reasons that you can go through this process to see if a life settlement might make sense for the client. In this example, we had worked with a financial advisor and a charity. They had donated 3 $1 million policies on a 79-year-old. The insured was living longer than anyone projected, and now premiums were due. And they're trying to make a decision: do we just cash this in for about 50 grand, or do we consider trying to maintain the policy? Well, the premiums were much too expensive to maintain, so they were about to go through the process to cash it in, much to the dismay of the client. However, one of the advisors had worked with our organization, and they said, hey, Asher, we're about to go down this path. What do you think this policy could be worth? As I sit on the board for this museum, and I don't want to lose any potential opportunities. We end up generating the secondary market value of $800,000 for this policy. So this insured was able to see the benefit while they're living. They were able to honor the insured at their annual gala with their family being able to see this. So this life insurance asset that they truly did not even want to take in, it was go back to that secondhand smoke slide, that they did not even want to take in, they then proved to be their biggest asset that they owned. They had their staff, spend a year interviewing hotel and caterers, and they said that they generated more on just reviewing this client's policy and monetizing their policy than they did at the entire gala. So let's just say they had a different view of life insurance after this, and as fiduciaries to the sitting on the board, they were really happy they didn't leave $750,000 on the table as well. And now the donor got to see the benefit and how that money was being put to work. So it's a really just fantastic story. This story itself is also one of my favorite stories. It's about a family that we were working with. It was with a law firm and a financial advisor. The adult children were really just having a hard time. It was pretty dysfunctional from who was going to fund their parents' caregiving for their 84-year-old mother. She was getting skilled nursing care, and it was, she was living longer than anyone projected, and now all the burden was typically falling on one of the adult children. The mother ends up taking that policy and working with our firm and the attorney and the advisor and selling the policy for $150,000. So instead of zero or just someone continuing just to pay for this policy, they end up generating six figures, which they then were able to reallocate to fund their caregiving needs. This was a pretty interesting structure that we can email you some information on. The $150,000 was placed into an account in their name with a bank that paid out monthly caregiving, and this qualified as an approved Medicaid spend down. It's really more of a little bit of a deeper dive into another conversation. We can send you some information on this type of strategy itself. It's one that's very helpful even when you're dealing with your more sophisticated adult children, but it doesn't mean that their parents are have as many assets as they do. So when you free up liquidity by those adult children that are funding this caregiving, you're now opening opportunities for you. So you're freeing up the obstacles of why they're not doing planning with you because their money's tied up caring for their mother. The numbers are huge in the size of this market. If you think about how large these numbers are, it was estimated that over 100 billion of policies lapse on people 65 and older, and a lot of that was inclusive of term policies as well, but I can tell you that's a pretty common part of our business is looking at those types of policies. And when you think about hundreds of millions over the next few years will be lapsed without ever being valued or monitored of any sort, can you imagine the amount of wealth that from a generational wealth perspective is not being passed along? Can you imagine if even a small percentage of this is your clients? Imagine if those of you on the call today each had 5 to 10 clients that had, if you work at a bank, the odds are they probably have at least $1 million policy. Imagine if you had 10 million of policies that were at risk this quarter, or could be worth significantly more than the cash value if you added this type of data point to your documentation. Some studies were done, and on average, out of those, they project that 20% were worth 6 to 7 figures more than the cash value in the contract. So what are the costs and consequences of doing nothing? And we all know that. We see it in planning. We hear about celebrity stories of when they didn't do any planning and they donate back to the U.S. government tens of millions of dollars, things like that. Well, can you imagine if just on a small scale, some of the families that you work with are letting policies go? I'd be surprised if many of you on the phone haven't thought about a few families that you've worked with over the years that this might have made a lot of sense for if you had known about it then. And as I said, again, ITM is 21st is one of the few that I've seen proactively educating on a consistent basis, because you have so much on your plate, and we understand that. We're really good at one thing in the secondary market and understanding life settlements and longevity. You have so many changing rules and pressures that are coming down. The only way for you to truly be able to do this consistently is to integrate it into your existing process, whether it's your discovery tools or things like that that you have in your process. Talk about have you explored having these policies valued? And that doesn't mean trying to write a new life insurance policy. It just means proactively managing it like any other asset that you own. There were studies done. Government looked at this market years back, and the industry is bigger today than it was back then. We have an aging population, or a third of the U.S. citizens are moving into this demographic. But this study was done, gosh, now 7 years ago, that on average back then we were generating 8 times more than the carriers were returning to the client. So it's amazing when you think about those numbers. And that's what energizes me about what we do. I love doing what we do for a living. I love that we serve the generation that we do. I like that we're able to provide liquidity events, which gives them independence, autonomy, planning opportunities for advisors like you to help guide them in the right direction. We help create liquidity. It's like finding an unrealized asset sitting at your house that might be the most expensive asset that you own. We see this all over the country. We see communities where people are living well beyond 100. They're living longer than anyone projected. They've been through all different types of booms and busts over the last 10 years, and they're looking for someone to provide a proactive type of solution on ways that they can maintain their financial independence. And you have an opportunity by including this. This is not a silver bullet by any means, but this is certainly one step in the planning process that will help you provide more comprehensive planning. Let's talk a little bit about the process as we wind down this presentation, and I'm going to make sure that I leave enough time for some questions if there are any at the end. So how does this begin? Let's say someone on the phone right now is saying, I might have a client. I don't know if this will make a bit of sense for him, or if it could even have value in the market. What do I do next? What do I do first? Well, the first step in our process is really just screening, and this takes place in week 1. And at that point, you're either going to move forward or you're going to note your file and move on. But either way, you're going to know this in week 1. All we need to do is review a current illustration so we can look at the values, and we can do our analytics. We can make some longevity assumptions. If you provide some basic understanding of their medical history, the types of medications or prescriptions that they take, anything that'll help give us a more customized longevity estimate, then we'll be able to come back to you and let you know what the projected range of value would be based off each of those longevity assumptions. So if I take away some of the fancy talk, what I'd say is, let's say Mike had brought us an opportunity and said, gosh, John, well, this makes sense. I have a meeting with a client over the next week or two. We might look at it and say, Mike, on this $1 million policy, based on a 6 to 8 year life expectancy, we believe the policy is worth between X and Y. If it's 8 to 10 years, between Y and Z. If it's between, and on, 12 to 14 years, and it'll be worth between this range. So we're going to let you know. It may or may not beat the cash value in the contract. If it doesn't, note the file and move on. Or it might make a tremendous amount of sense, and you just got ahead of a problem where this policy was about to blow up or run out of cash value, and you saved the day. It's a pretty interesting place for you to be, because you can add value in ways that others are not. Next, if it does pass that screening, we're going to go through our underwriting. And as I talked about earlier, no medical exams required. And at that point, we have a forms packet, all the proper authorizations that we need to be completed to demonstrate that we have the authority to review this information. It's just a HIPAA. It doesn't bind the client to selling the policy, nothing like that. It just provides the authorization. We're going to review any and all available carrier documents, a copy of the policy. We're going to really just deconstruct the policy, roll up our sleeves, and do all the wonky analytical things that we do every day. We're gonna review some independent underwriting reports that we work with from regulated entities within our market. Those provide an additional analysis and data point for us to consider in our overall underwriting. And then we're going to talk about this with you so we can design the most favorable, attractive policy to create the most competitive bidding process to drive up the value to the client. As we move into that negotiation and hopefully offer acceptance phase, we're going to do exactly what you saw back on that one slide. We're going to negotiate with all the licensed buyers. These are not individual investors. These are legitimate, been through the due diligence of every state insurance department, the best of class purchasers within our space. They have one objective and one objective only. It's to deploy capital and purchase life insurance assets for their portfolio or for their funds that they work with. It's our job to create the most competitive bidding. We 100% sit on the same side of the table as you. They sit 100% on the opposite side of the table. And their goal is to purchase as many assets as they can. As I said, they're trying to do this in a compliance-centric way themselves to generate the best rate of return for their fund. We have a healthy relationship with them, and many of them we've known for many years, anywhere between 5, 10, and even 15 years. So they're running a business as well. So we're going to guide you through this part of the process, and they guide their fund and their investors on their side of the process. We're going to provide full transparency and provide all the appropriate paperwork and guide you through that whole acceptance process itself. Once again, here's that snapshot. Do you want one potential offer or multiple offers driving up that bidding process? As I just described, no different than this client here or the client selling that policy that was donated to the charity or the business owner or the policy sitting in an ILET. The objective here is to deliver the highest liquidity event we can from licensed parties on all sides of the transaction. And we will guide you through this next stage of the process that deals with contracts. These contracts are all state-approved documents. You'll see a code on the bottom corner that'll demonstrate that they should not be, be able to put any different landmines in there that could be less advantageous for your client. My firm and firms like mine will review these documents on your behalf to provide any type of document preparation or just to ensure that all of the wording is accurate for the transaction themselves. We will work with the purchaser to ensure that all deficiencies are being met. Similar to selling a piece of real estate, this would look just like a title closing. It's about an inch thick, sometimes a lot less, depending on the different funds that we work with, and everyone signs off on the transaction. If it's a community property state, the wife or husband will sign off. In my 15 years of doing this, working on thousands of transactions, billions of death benefit, we've never had anyone say, not once, you tricked my poor Aunt Sally. Because my question would be, well, you did initial this 32 times. How is this so much of a surprise? So all parties are in the know. And that's an important thing as well. Everyone signs off on this. The insured has to, even if the policy is owned by a corporation, the insured has to sign off. Everyone has to sign off on this transaction. So from a risk, reputational risk, liability, that's something that you do not have to worry about in 2017 compared to the early 2000s when the documents just weren't as comprehensive. So hopefully that'll also put you at ease, but we will be guiding you through that whole process. Once that process is completed and the changes are recorded at the carrier to the new fund, the largest securities intermediary that manages these types of policies, as well as Fargo, they serve as securities intermediary, and I say the largest in the market. It's also Bank of Utah and many others that do work within this space. But there's always an escrow agent involved. There's never any type of nonsense if you work within the regulated institutional framework of this market. The client has and the majority of the state has a 15-day rescission period where if they change their mind due to a change of health or the wind blows in a different direction, it could be as broad as they want. It's a senior consumer protection. They have the right to unwind the transaction. Even if it's a 10 to 15 year projected life expectancy and the insured, it's one of those things that come out of nowhere and the insured passed away, it's an immediate rescission. So everybody's protected throughout the whole process. I can tell you in 2016, we had many transactions that began, but the time they begun and they ended was around 30 days, but average around 90 days. So depending on the availability of information, how proactive the advisory team is that we work with, you have an opportunity to really compress those timeframes, because every week that client or a decision is put off or it's sitting in a trust committee to make a decision, the client's account value is changing. They might be 25% closer to having to pay another premium, and you really want to make sure that as a fiduciary, you're not the cause for the delay, because that is could come directly out of that client's pocket. So having an efficient process where everyone's collaborating and working together, efficiently is always key, no different than any transaction that you get involved with. So how do we keep this simple? No different than any other asset that you own. When's the last time you had it appraised or valued? Talk to your clients about that, and they're going to say, I'm not sure what that means, or can you explain that a little bit more? Oh, well, there's an institutional secondary market where you can appraise your life insurance like you appraise other assets. We've worked with some independent firms that specialize within that. Would you like us to explore it? And I can talk to you more about that, or we can do other types of webinars for your organization on how to, from best execution or best practices, what to do next as you go through this. So I'm going to recap of where we are right now, and if there are questions, fantastic. If there are not, you'll see my contact information on the next slide, and then I can answer those in private, or we can schedule another time. So what I'd ask you to think about within your group, your company, your trust committee, whomever it is, how many clients have surrendered policies that were worth more than the cash value? And could there have been liability for not exploring this option? Could you lose trust with those clients? Or conversely, if you approach your client with this prior to anyone else doing that, can you build a client for life? Can you be that one that the client looks to and says, you wouldn't believe it? They're so on top of it at the trust department that I work with. I had this policy I did not even realize was worth X amount of dollars, and they helped me do that. Therefore, a windfall to the trust, you're helping yourself. The settlement process itself, you don't need to be an expert at this. In fact, there's more value in you not trying to be the expert and collaborating with those that do this full time, that are professionals within this space. We all know that accommodation trustees in your market are one of the most dangerous things to work with. That uncle, that aunt, that young adult child who serves as trustee, and they don't remotely compare to what the level of work and competency you can bring to the table. Well, the same thing goes for this market. And being able to collaborate with licensed specialists that have a responsibility 100% to the client will help simplify your process, minimize mistakes that could be costly to your client, and of course add value to your different relationships that you work with. So going back, just talk to your clients, talk to them about a webinar you sat on, and where it turns out there might be a way to appraise your life insurance like you appraise other assets. Would that be of interest to exploring that with you? I'd like to take a moment and just thank everyone for taking the time to be on this webinar today. I'd like to thank ITM 21st for continuing to elevate this market and continue to proactively educate. We've done this and spoken at many estate planning councils around the country. We're on the Speakers Bureau, so if you have a local estate planning council and you think this would be a valuable topic, please let us know. I'd really encourage you to connect with me on LinkedIn, Twitter, things like that, and we'll keep you current if there's other regulatory changes or just some interesting speaking points that could be helpful to you in serving your clients. Most importantly of all, this is a pretty interesting time, and we've seen with a change in government that if there is a change in estate taxes, there's going to be a lot of clients who have policies that this might be worth exploring. It might open up opportunities. Regardless of what happens, though, I can assure you this: estate planning and planning with your clients is alive and well, unless they create a magic pill that helps business partners get along, husbands and wives, sing kumbaya, and adult children all get along well together. There will be changes in people's lives, and when there's changes, there's opportunities for planning professionals like yourselves to help everyone. So maybe this will serve as a catalyst for you to be able to do that. And if we can assist you in any way, we're here to do that. I appreciate everyone taking the time today.
John, I got 6 questions, but I really can pull them into 3, and I think they're all really good. The first one is, someone is asking, why would a life insurance company buy a policy for much more than it is valued? Now, it's not a life insurance company buying the policy, although one of the life insurance companies out there has purchased a lot of policies. These are policies that are sold to investors. So, John, just take a second and explain why investors are interested in life insurance.
Yeah, absolutely. It's some of the largest, asset managers on the planet: the Blackstone, BlackRock, Buffett, Apollo, AIG had a $15 billion pool of policies. There's all different types that when they look at this, they can literally purchase a multi-billion-dollar pool of policies, and they can have a 5-person longevity desk manage that asset, because mortality, unlike the equity markets, is a little bit more predictable. And forgive me for inserting a little sense of humor when we're not face-to-face here, but until they invent the vampire pill where everyone's here forever, then you have a market. It's no different than insurance itself. It's a mortality longevity structure. Well, compared to life insurance, this one, they know that at some point someone will pass and the death claim will be paid. All they have to do is pay the premium when they go after that. So you're talking about large pension plans, some of the biggest ones in the market that were upside down. They have no clue how they're going to reach their future obligations. However, if they can build a $1 billion pool of policies and it costs them a third of that to fund it, to purchase, to meet that obligation, that's a great deal for them. The equity markets are going up and down, and they're all over the place. They know that this type of an asset is a non-correlated asset. They don't have to worry about the price of oil in 3, 5, or 10 years. Pay the premium, receive the death benefit.
Quick question on income tax. Obviously, life insurance held in trust is not taxable, but once you sell a policy, it is going to be in some form or shape possibly taxable, correct?
Yeah, absolutely. And from a compliance perspective, if I don't say we are not tax advisors, and we cannot give tax advice, there's a high probability this line will go dead and all power in my office will go out in the next 5 seconds. So I will tell you that if you shoot me a quick email, I'll send you an article that we co-author with an attorney regarding all the different implications of the tax implications of those different revenue rulings. I can tell you this, we've never had one not go forward because of it.
That's a great answer to the question, because it isn't, I wouldn't say it's, gray, but that's a great answer. Now, last question is kind of 2 questions, and the first is, how do you get paid, John? And people don't need to have a broker to go through you, correct? They can go directly. The trustee can pick up the phone and call Asher directly. They don't need a broker, correct?
Yeah, that's correct. Yeah, we work directly with many different fiduciaries. That's something that we're licensed to be able to do. And we generate fees by a value created, the success fee model. So we're totally aligned with the client. The more we deliver to the client, our fee increases as well. We also do different types of fee-based work if we're just doing assisting in reviews or planning situations with clients. I can speak to that more if that individual would like to get to me. But from an overall fee perspective, the better and more value we deliver for the client, the better revenue opportunity it is for my firm. So we have skin in the game to always do what's best for the client.
And anything that's done is done with, with, as you mentioned, total transparency and a contract, or at least this is how this transaction, this is how Asher's going to get paid in this transaction, correct?
Yeah, absolutely. Right up front, we share all that type of information in writing, and then as we go through our process, we then share it again in writing with a bid transparency, where it'll look like a closing statement that we sign off, rep, and warrant, because we want you, for your file, to have something that's defensible, demonstrates that, once again, you worked with those that were aligned with you along the way.
Well, we're heading to the top of the hour. I appreciate, John, you taking the time. One thing I wanted to mention is one of the reasons why I've been so vigilant in talking about life settlements is that when we first got into as ITM first started, in the first few years, we would take on blocks of policies, and we would see that a policy was gone, and a trustee would say, well, I surrendered the policy on an 85-year-old, I surrendered the policy on an 86-year-old, and they never went to the secondary market. And the one thing that I would say from a fiduciary standpoint, even if your client cannot sell the policy in the secondary market because of their health or the cost of the premium or a COI increase or whatever it is, it's important that you at least reach out and see what the options are, because this is what I always tell our trustees: 10 years from now, 15 years from now, should that client pass away, or a year from now, whenever, you may not be able to go back and recreate for your file what the options might have been at that time. So it's important, even if the option isn't there for the client, to reach out and try to find out whether it is an option. So I appreciate everybody taking part in the call today. And John, great job. And anyone has any questions, you can reach out to John, or you can reach out to me, Michael Brohan. And again, John, thank you very much, and thanks everyone for attending today. And hope to see you next month on our policy review webinar. Thanks again, everybody, and thanks, John.
Thank you. Have a good afternoon, everyone.